is higher than ever. And that means that the usual antidote for inflation, which is raising interest rates, slowing monetary growth, the repercussions of that going wrong are higher than any time in history.
Is there a relationship between the level of debt relative to GDP and economic growth of that country? In other words, GDP versus debt?
Sure, the higher the debt, the lower economic growth. But debt, ultimately, if it's going to be repaid, slows economic activity. If you're going to service the debt, it basically retards economic activity.
You could just not pay back the debt and default.
Which gets into systemic risk argument.
Is there a possibility of a default in the US? I mean, there have been historical precedents of many defaults, let's say in the late 70s, and then in the Civil War, there was a short period of default. But the US is rated AAA by most
rating agencies, which of course are,
If we were to enter a period in which a sovereign debt crisis becomes not just fiction,